Very warm welcome to each one of you. Markets have been not so clear in terms of the movement that we've seen. We've seen up movements, we've seen down movements. Essentially, this market is more of a choppy market where Nifty is still around those same levels, probably what it was maybe a month back. So in this kind of a market, it becomes even more important to be very pinpoint and accurate with the sector picking, stock picking, and most importantly, getting the timing right on these setups. So we have a few charts, very interesting ones, which we can see and basically gauge where we stand in the current market situation. So just hang on with me. I'll start screen sharing and we can all have the presentation. Yeah, so decoding Nifty. So this is where today's presentation is all about. We'll discuss about the performance, the structure of the market, and essentially what is the outlook. Now, as you can see in this graph, this is the global indices, global equity market performance over the period. How India has underperformed massively as compared to some of the global peers. So we are all aware of this story, but this is the magnitude of how things have gone. So something like a Kospi, Taiwan, these indices have literally taken off in this period, and essentially Nifty is sitting right at the bottom of the global equity umbrella. So if we dive into it and what could be the reasons for it, so clearly it is the rising crude oil prices which are hurting our sentiment the most. This has increased the cost of imports. The current account deficit has widened. Now that has pushed the rupee to around 97 levels. So we are also one of the weakest performing currencies globally as well. And that essentially over a period of time will translate into inflation and the cost of living going up. Now, amidst this, there is also a global slowdown. We had that Iran US thing, which is still going on. There is industry specific shocks as well. We've seen a massive wealth destruction happening in the IT space due to the AI boom. So these are challenges. A lot of us are aware of it. Eventually, they are playing a role in the underperformance of the market that we are seeing, and it will take time for these fundamentals to change. Now, if you look at the monthly chart of Nifty, the long-term structure of the market is still intact, which means this seems like although it feels like it is a terrible correction, but essentially price-wise we are not really headed down south. We are still holding on to above the key EMAs on the monthly charts. The higher high, higher low structure is still intact, but the question is for how long can we sustain this structure? So going one step into it at a micro level, or rather at a weekly level, the weekly charts are suggesting that the structure is pretty much sideways, and it is very much similar to the period that we had in 22-23, where we spend a lot of time grinding back and forth between the range, multiple attempts being made to break out from the market. In fact, it was very much similar amount of time that we have spent currently as well. And like we saw in that period 22-23, the breakout eventually happened, and then we saw markets rallying all the way up to from 18,000 odd index. Nifty went up to 26,000. So this time around also very much similar in terms of the technical structure on the weekly time scale, which means sooner than later we may see a breakout happening on the index, and we may see it head towards higher levels from the current trajectory. So if you look at the sectors which form the backbone of the trends that get established in the markets, so in the past 1 year, it has been the metals which have led the market, 44% plus a return by Nifty Metal Index in a period of last 12 months, followed by PSU banks, which have been positive by 21%, followed by the defense index, which is around 14%. Now, goes without saying, it is the IT index which has been the worst hit at 27 1.5%, and then Nifty, as we all can see in the black, is at around 4.26%. So there are some green shoots that have happened. We have traded multiple times in the metal space, PSU banking space, as well as recently we had recommended the pharma basket, which did very well. So there are pockets of the market which are doing well, and the entire market, like Nifty, may be struggling at a year-on-year level, but there are pockets of the market where we can see returns being generated and wealth creation happening. Now, slightly more granular, this remains pretty much similar on the 6-month performance sheet as well. The reality index is the one. Reality and IT are the ones which have been lagging in this space. However, in the past 3 months, if we see, it is defense which is apparently leading the show. Goes without saying, because of the backdrop of the geopolitical tension that is brewing along. In fact, the PSU Bank Index have pulled significantly. In the last 3 months, as you can see, PSU Bank Index has pulled down, Bank Nifty has pulled down. So banks and financials have taken a hit in the last 3 odd months, which is why we're seeing the overall sluggishness in a lot of names in the banking and financial space. Pharma and energy continue to lead, as well as metals also have been doing well. Now, in the last 1 month, clearly it has belonged to pharma. So, which is where we had our pharma basket recommendation, which did very well. And as you can see, banks and financials continue to lead, along with the IT space, which is again at the bottom of this chart. So from a comparative basis, clearly there are these 2 or 3 sectors which are doing well, like pharma, defense, metals, energy, FMCG. These are the typical names which have been doing well in this period. And the prime culprits of keeping the markets down have been the IT, followed by the banking and financial space, and reality as well to a great extent. Now, this is essentially our technical view for these sectors for the next 1 to 3 months. So in metals, we maintain a buy on dip stance. Pharma remains one of the stronger names. We maintain an accumulate and buy on dips stance in the same. FMCG is another sector where, as a defensive, it has reached levels where accumulation can be done. In terms of the individual broad-based sectoral indices, like the mid-cap 100, mid-cap index, as we all know, was the first one to hit a new 52-week high. And this was before Nifty did that. So very rarely does it happen that small caps and mid caps lead the way and large caps are the ones which are lagging behind. So we had that period where mid cap 100 index is doing well, the Nifty Next 50 index is doing well, small cap is emerging, micro cap is emerging, whereas Nifty is weak to sideways. So this is a very interesting observation in terms of what is moving into the market, what is moving in this kind of a market. And it could probably be remain the same in case the variables at a macro level don't change. So let's say the current setup continues for another 1 month or 2 months, we may very well see these outperformances continue into the market. So this is a snapshot of sectorally how do we see these indices, both sectoral as well as broad-based indices, and what is our technical stance on the same. So a lot of indices like the Bank Nifty, Nifty, Fin Nifty, these are on our avoid list, meaning they do not inherit any strength at this point in time. In fact, they are leading on the downside. So it's best to stay light on them, best to stay very narrow focused in this kind of a market, as we all know, the kind of underperformance that has been there. Not only from a 1-3 month time frame, but even from a 6 to 12 month time frame also, the returns are not there for everyone to see. Now, moving on to the next slide, this is the pharma index, which is the strongest of the lot. Around 23,000 we saw the previous breakout happen in the index. The index may spend some time over here, but eventually the index is headed towards 26,300 or 28,000 plus over the next few months. So pharma index continues to remain our preferred sector in this kind of a market, unless and until the market changes color, texture, and we get into a zone where the entire market starts doing well, I think as a defensive, this sector plays very well and should continue to do well as long as Nifty doesn't come out of the woods. Now, in today's session, we'll also be discussing what is that level above which Nifty, the shorts can get challenged, and eventually the markets can change gears if that happens. So stay tuned. We'll be discussing that level, the most important level in the Nifty, above which we think that things should change. Now, healthcare index is very much similar to the pharma index. Very similar breakout happened recently around 15,000 odd. Here also the targets are pretty decent. 16,678 around 17,650 is the second target. Very much similar to how the pharma index is done. Now, crude broadly is consolidating in a broad range, and this is a weekly chart, and eventually I think based on which side the breakout happens, we will see decisive move happening on the crude, I think, but some more time would be spent. I will not be surprised if we spend another month into this range, unless there is a big shift that happens geopolitically. I think crude may remain elevated and may just consolidate for the time being. These are the levels to keep an eye on. $108, $119 per barrel on the higher side, and on the lower side around 87 and 79 as per the support levels. Now, gold, is facing a time correction. We've seen a big up move up to $5,500+, and post that we've seen a correction, sideways consolidation. Now, in the very short term, there is a bounce back which we envisaged, and gold did give a 5% bounce back in a very short span of time. But as of now, the texture is again pretty much sideways. In fact, if it does sustain below the $4,500 mark, maybe for a couple of days, we may see it heading towards 4,380 or even 4,100 on the downside. So this could be that end of this time correction, post which a new trend may emerge. So gold, it's best to buy on these dips, best to buy closer to these support levels. The most recent one is 4,500 roundabout, and above below that 4,380 and 4,100 on the downside. Silver, again, it tried to break out around that $89-$90 mark, but saw sharp selling happening post that. And again, multiple supports placed on the downside as well. Again, this is brewing. This is still work in progress. It will be interesting to see how this chart plays out. In case you want to participate in this, and in case there is a breakout on the same above $90, I think that is where the big breakout could happen in silver and may retest 110 on the upside. But I think it will take some time before this move happens. Now, market outlook. Now, for investors, the strategy is simple. Accumulation is preferred. This is a good time to accumulate into ETFs. The structural support for the Nifty is placed at 21,700, 22,000. In case it happens to be a sharp sell-off in this month, these are the levels to keep an eye on. Overall, I think as a trader, this is a market which will help a lot of traders, because there are swings on both sides. If you are an index trader or a stock trader, stock trading may be difficult because the number of stocks behaving in a particular way is very narrow. But for the index trading, ample levels to be trading on both sides. Overnight volatility is there, intraday volatility is there. So from trading perspective, definitely things are looking very good. Now, the most important level to keep an eye on the Nifty is 24,600. If we close about 24,600, that will negate the current sideways structure, and Nifty may get into a bullish zone where shorts will get challenged, and we may see a short covering based rally that gets triggered from there, and things may improve significantly once that happens. But until that happens, I think the volatility and the grinding may continue. But keep an eye on the 24,600 level. If at all, when it takes out, that should be the level to keep an eye on. Now, the strong sectors, as I discussed, it is pharma, healthcare, energy, defense, and metals. The emerging ones are FMCG, media, public sector enterprises, and infra. And in terms of the market cap-wise preference, it has to be the mid-cap Nifty which is positioned very, very well. Now, crude oil continues to remain positive, like although it is consolidating, but it is still staying elevated. Gold, the long-term structure is bullish, so look to buy on dips. Silver also, the long-term structure is pretty much bullish, so look to buy on dips or buy once the breakout happens. Now, if we look at how markets have changed, how FI outflows have dictated the market, let us take one step further and see. Now this is very interesting. So price is what everybody sees. Essentially it is the liquidity that has to be kept a track on. So from a liquidity perspective, clearly, FIs have been pulling money out in the cash segment. There recently, a few days, we saw some green figures, but there is some time before they turn properly, net positive on the Indian equity space. That may take time. Also, the weakening rupee doesn't help over here. On the derivative side, we see very strong positioning on the short side by index by FIIs, and this is essentially keeping the markets lower. In fact, derivatives markets are much bigger than cash markets, so the depth of the market is essentially in the derivative space. The FNO to cash turnover ratio as of last year is around more than 2x, and derivatives markets have grown significantly from there. So derivative positioning of FIs has to change if the markets have to take any sort of a reversal from here. And this is where the most importantly the factor, the long short ratio of FIs that we track on a daily basis will be closely watched upon. So participant wise, basically there are FIs, FPIs, mutual funds, proprietary desks, and retail traders. So retail primarily has been on the long side for this entire period, and they have probably benefited whenever we've seen these short spurts of upswings in the market. But more often than not, it has been FIs which have been getting it right through hedging, through the short positions that they've created on the downside. Now, if we look at this is the important slide. Why are FIs selling into the Indian market? So clearly the US 10-year bond yields are rising, which means emerging markets take a hit. That is one of the biggest reasons why FIs have been pulling money out of the emerging markets, especially like India. India still, on a comparative basis, commands a premium valuation about 19-22 times versus 11 to 13 times in China. The relative overvaluation is also, one of the reasons why money has flown out of India and to other countries in the emerging market kitty. Now, simply put, until last 2 years, the emerging the opportunities in the markets like USA, Japan were too good to be missed, and India was essentially at the bottom of the pyramid, which is why we've seen this outflow of funds. And lastly, if you look at the domestic financialization that has happened, SIP flows have been very strong. They have in fact accumulated the shock of the FI selling figure that has happened. This tug of war has essentially meant that markets have not moved in any significant direction, and we've remained in a range over the last 2 years or so. Now, so some of the strategies that we've recommended as a team, so our recent strategies have been, this is the Nifty daily chart. Multiple times Nifty faced resistance around the 24,500 area. We've recommended strangle strategies around this period. In fact, we also recommended a bear put strategy once the 24,000 support level got broken on the Nifty. And what has essentially played out is, these strategies have done very well, especially when it came to timing the market, on these specific resistance levels, and that is bode well for the overall setup. So now, what should be your strategy? So there are some of the strategies that the team has worked out on, although the prices would have changed once when the strategies were initiated. But essentially, the idea is this, that in case. Okay, so let me beg your pardon. Let me just quickly move on to the performance of some of the recommendations that we've given. So in the technical calls, we maintained a 76% monthly strike rate. On the derivatives calls, we maintained a 73% strike rate. Overall, this has been the performance. Average number of calls on the technical side has been 106, and average number of calls on the derivative side have been 42. So these are some of the ideas. Some of the ideas you would be receiving from social media. Some of the ideas you would be receiving, directly as well if you are a client of JM Financial. So look forward to onboarding you into the JM family and essentially sort of helping you in your equity journey, going ahead. So net, we expect market volatility to continue for the time being. If 24/600 is taken out, we feel that there is more upside to be had. But unless that happens, I think it is better to wait on the lower levels, and on the downside, supports are placed at 22,000 and 21,700. Thanks to each one of you.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.